Hey everybody, Economic Ninja here. I hope you're doing great. We're going to talk about the markets today, but we're going to also a little brief overview of today's markets because we had a good downturn in the markets. But we're going to be talking about mortgage rates for real estate market, mortgage applications, and adjustable rate mortgages. We're actually going to be doing a lot of things, and it's based off of somebody I know that is a frustrated buyer right now that just got turned down for a mortgage for a fixed 30-year or 25-year. But now they're looking at an adjustable rate. And I'm going to make a video about this scenario. And we're going to talk about that. So first, we're going to jump right in right now, and we're going to talk about the markets. Okay. So I just had the market close down sharply 638 points. However, excuse me, with today's day and age of how high the Dow is, 630 isn't that big of a deal. But in 2008, it would have been sending markets reeling. But let's point out why. It says right here, they fall sharply on pivotal inflation data. It cannot wait. The market cannot wait. The street cannot wait to find out if inflation is going to be higher than it was last year. I'm going to go out on a limb, guys, and say it's going to be, but that's just crazy talk for some people. We are in an inflationary spiral right now, and quite frankly, that's why it's going to lead into this housing talk. But again, we're going to talk about a couple things here. Gold down just a couple of dollars, really nothing there. Oil still sitting above 120, and I believe it's going to be going much higher in the near future. And then we have bonds. Look at this. The 10-year bond is sitting steadily over 3% now, okay? And it's came down off of its highs just recently, but we're going to dive into some news articles, and then we're going to talk about some charts that I think are really going to teach you a lot about what's going on in the markets and give you that big overview, okay? So first on, let's just do some headline reading and let's talk about it, okay? So when you type in mortgage applications on the DuckDuckGo and you hit news, let's see what we got going on. U.S. mortgage applications are in meltdown, and the threat to house prices is growing, an economist says. Now, this is interesting, right? It says right here, U.S. mortgage applications are in meltdown. Threat to housing prices is growing. That's obvious because the less mortgage applications means there's fewer buyers out there due to higher rates and all kinds of things, including inflation. And it also means that there's still a certain amount, even though we're at record low inventories, there's less buyers for those homes. So what are we going to see? We're going to see more price reductions. And the more price reductions we see, we're going to see more and more homes hit the market because of homeowners that are afraid. They've been waiting. They've been on the fence line if they're going to sell or not, and then they're going to dive right in. Okay. And that's going to get really exciting. But it isn't the time to buy it. I'm going to explain a little bit later. Mortgage Bankers Association index of applications tumbled again last week and has fallen dramatically since January. That is true. And then it says here, Patheon Macroeconomics said the chances of a short period of clear declines in home prices are growing. Now, it's really fun that somebody comes out and say a short period. Well, no duh. No duh, there's going to be a short period. I'm telling you there's going to be a long period, but I'll be that guy. I'll be the guy. This isn't financial advice. I'm not a financial advisor. Just do with bro hawk and a dream. All right, now let's talk about adjustable rate mortgages right here. People are news headlines. Should you consider an adjustable rate mortgage? Why are adjustable rate mortgages are still risky? And I think that's a really good one, but we're going to talk about that in a second. And it says right here, more home buyers are turning to adjustable rate mortgages, but are they right for you? And it's very, very true. Right now, adjustable rate mortgages since January have been exploding because of the increase in mortgage rates. And it says right here, it just gives an example. With interest rates on the rise, a lot of home buyers are looking into adjustable rate mortgages to help them save a little money. And I want you to realize that too. It is a little money that you are saving for a lot of risk. Back in January, the Mortgage Bankers Association says all of the mortgage applications out there, around 3% were for adjustable rate mortgages. Now, this was back in January. Now it's around 9%, so 3 times higher, but 9% is still very much the minority, and a lot of people have no idea what an adjustable rate mortgage even is. Okay, so I want you to understand right now that 9% is actually a pretty significant number, to be honest with you. I do believe that we could see it bump. I want to say the highest it went in 2008 was 18%, but why don't you guys do me a favor and throw it in the comment section? But I'm pretty sure we bumped 18% was the highest rate, because we had not only adjustable rate mortgages, but we also had pay option loans, which were negative amortization loans. So now we're going to dive in. Oh, let's see here. I love the drop down boxes for Zillow. or zoom it. We're going to go into the next story here, or here. So the charts. This is what's very important. And I'm going to bring you to the comment from a buddy that I was listening to the other day. So we got a really hard decision to make on a house. The bank is willing to give us a mortgage over a period of term, 25 years. But this could be the same for a 30-year, right? But only the first 5 years will be fixed at 2.5%. Then it goes onto a variable rate, tracking the base rate. All right, here's the thing. This person has been trying to get a fixed rate, which is a very intelligent thing to do. That is good in a time like this, where we have a Fed rate hike cycle. All right, I'm going to tell you about my past and what I think we're going to go through. I started buying real estate in 2001. The reason why is because interest rates came crumbling down. Let's see, this is a 20-year. Let's go all years real quick. So right up here at the top of the .com boom, when the boom and bust happened, it actually happened back a little bit farther. Interest rates started to fall dramatically, the Fed funds rate. And the reason why is because the Federal Reserve had to juice the systems, had to get money in there, liquidity, cheap lending and borrowing to goose the system. Well, I started buying real estate right there. Sorry, right in the beginning, spring of 2001. And I started buying. My first mortgage was at 7.25% for my first home, and I bought my first rental about 6 to 8 weeks later, right? And I was on my first. So my first house was 7.25% interest for the mortgage, 30-year fixed, and my first rental property interest rate was 8%. All right. So now as I started buying other homes and interest rates were dropping, I was refinancing all the way down. And what happened is home prices started to accelerate upwards, and the payment was going down because I was refinancing on the way down until we hit the bottom. And if you notice, we're going to pull back to the 20-year. This time period right here. So let's see, it started around 2003, lasted till almost mid 2004, right? Flatline. We were feeling pretty good. The economy, the Federal Reserve was going, hey, things are good. We're going to start raising rates. And they had this dot plot plan. And literally you could see it's almost like a stair step. It was almost literally to the week. They would just bump it a quarter, bump it a quarter, bump it a quarter. It was like clockwork, right? And what happened up here, you're probably wondering, this baseline, this is the oh crap moment. This was oh crap. And you remember when I told you mid 2006, I started selling all my real estate because he knew the crash was coming? Was because Ben Bernanke back here was telling you everything was okay. It's okay. There's not a housing bubble. We got it fixed. Don't worry. The MBS market is good. See, the mortgage-backed securities market could not handle all of these interest rate hikes. Why? Because the loans were made in a different era, a boom cycle at much lower rates. So as they came up, it was too much to handle. All right. So right here is that oh crap moment. And this is the time the ninja went nuts and started offloading everything. And by all accounts, as witnessed by his friends, let's say he was panicking, right? But then again, his friends didn't have all these houses to sell. And he was like, this is it, right? This is it. And it only lasted till about here. Now, remember, you guys have told, and I love using these charts with timelines to talk about this. Remember when I told you that we were already getting stimulus checks in the spring of 2007? Well, check this out. Let's go back to the spring of 2007. Spring of 2007 is right around here. During that oh crap moment, you see the Fed just leveled off and they said, you know what, we're going to hold it right here. We think we've done enough damage. And I can't say that more, sarcastically. It's true. They've done damage, and it couldn't hold. So what happened was right about here, the end of 2007, they started to lower rates. Now, it might sound crazy because you remember the crash of 2008 being, and I'm getting to the mortgage rates, all right? They started dropping the Fed funds rate because we were crashing, just like we are crashing right now. But what you are seeing, we are right here at the Bernanke moment. This is the Bernanke moment. I'm sorry, Maria Bartiromo. I don't think that I agree with your thesis. I feel that the housing market is strong and resilient. And by the way, housing cannot fall all at once across the country. Well, good news, Bernanke, you're 100% wrong. I hope you're selling out of that book right now because I love fiction. All right, so the thing is that this is where we are right now in that moment, that oh crap moment. And the Fed's about to do one of these. oh crap, and then it's going to drop, right? The problem is, and now you look, this is, oh, hey, just, you know, this is the recession back then. We're going to see that real quick here. But look at this. Check this out. 2010. This is where most of your YouTubers in real estate have been investing in real estate. Interest rates super, super low. And we're gonna right now pull back to that moment. Now look at this real quick, one more time. The interest rate hike cycle was from May of 2004 up till mid 2006. Check this out, the 10-year bond rate. This is a big pullback of the 10-year bond, which does really reflect mortgage rates, right? This is what we're talking about here. This is that interest rate hike cycle right here, from here to here, that quick. That little bit right there, that little bit in the bond jumping up is what made it so expensive for homeowners to go, I can't afford a mortgage. I've got to dive into adjustable rate mortgages. Hey, well, now we got adjustable rate mortgages on cocaine. Let's do a pay option arm or negative amortization loan. Okay, that's great. Okay, that's all it took right there. So here's the craziness. I want you to understand this. Let's go back in history, because look at that. This is what the 10-year has done in 6 months. Unbelievable, right? But let's go back to another time. Let me show you what happened here. This is what happened to the 10-year right before the dot-com bust. Boom, just shot up, right? Check out the 10-year bond here during the recession of the crisis in 94. And this is why I say it's a crisis. The 10-year bond, boom, blew up, right? Something that was interesting about 1994 is we had a recession, even though it's not pulling up on there, but we did have, we were like knocking on the door of a recession. The government put like, I think 3 points on all new construction loans to slow housing down. You see, the reason why is because prior to that, right here at the peak of the last recession in 1990, you had an 8.5% 10-year bond, right? So that means that mortgages were sitting around 9 to 9.5, maybe 10%, depending on your credit score. And from 1990 all the way down to 93, you had falling 10-year bonds, which means that, again, the mortgage prices were going down and the housing prices were going up. So by 1994, building was exploding. All right. Again, I hearken you back to, is that even the right word? I hearken back to 1980, the blow off top. Now, this is what I'm expecting here pretty shortly. Doesn't mean that we're going to be seeing 16% anytime soon. What I'm telling you is this parabolic move, because the late 70s is where we had all of this crazy inflation. And by the late, like 79, 80, as Carter was leaving, we had this massive blow off top. So 10-year bonds were increasing to keep up with inflation. All right. Now look at this, the inflation story. You can't even, remember when I said that lumber was going to collapse the last year, this time I said, don't worry, by July 2020, lumber is going to start crashing. And the reason why is because people are going to care more in August and September about how much food costs and fuel costs. Well, that's when food and fuel really started to take off. And look at, this is where I said that in the video. August was right next to it, right? And this is what the 10-year did. It's keeping pace. It's trying to with inflation. It means that people, I'm going to pull off this share screen. It means that investors or people that are loaning money out, or banks, institutions, they're going, why would I loan rates out when I'm losing money to inflation right now? So I'm trying to stay up ahead of it. And that's why you've seen since January, the 10-year just go on a total tear. So my answer to my buddy right now, I'm going to be honest with you. This is non-professional advice, of course. I'm a real estate agent, but that does not, I'm a really bad one, actually. I'm a real estate investor. I lived through this back in 2001 to 2008. A lot of people on YouTube right now have only been buying investment properties and their own real estate since 2010 to 2012. All right. They've only seen prosperity. They haven't seen a squeeze like this. And I'm going to tell you what makes this time so much more scarier, but at the same time, a better opportunity than back in 2008, 2005, when I was doing this, is that we have inflation, gnarly inflation, food and fuel, and that's going to send investors and the common man and woman spinning out of control, because there's nothing like gasoline going up another gallon to really bug people. There's nothing like a gallon of milk or a carton of eggs to double in price to really cause people to freak out. And I think that you are literally seeing the beginning of an epic real estate down cycle. And there's nobody else on the internet telling you that. No joke. You've seen me, guys. I've been talking about this crash since since last June, end of June. And I called the top and I still stand by it. And that is when inventory collapsed. And we nailed it. And people need to understand that's the start. Even though the prices went up, it's called a blow off top because of emotion and, quite frankly, a lack of education, financial education. That's when people rushed into homes and last minute out of fear, uncertainty, and doubt. And I think that's what's coming next, but on the downside. And it's gonna, and like they say, bulls walk upstairs, bears jump out of a window. That means that the downside comes super fast and super quick. It'll be pretty impressive to watch. I guarantee you're gonna want some popcorn. All right, guys, that being said, I thank you so much for watching. I hope this answers my buddy's question. With that being said, the Economic Ninja is out.